All right, let's get into it. I want you to imagine a kind of parallel financial universe, one that's humming along just out of sight, way beyond the world of ATMs and your local bank branch. It's a system so huge it quietly reshaped our entire economy. Today, we are pulling back that curtain and taking a hard look at the world of shadow banking.
So, what if I told you that back in 2008, this parallel system was on the hook for $20 trillion? That's trillion with a T. It was a massive financial engine running in the shadows, and honestly, its sheer scale was just breathtaking.
Now, really zero in on that last part of the quote. This system wasn't just big. At its absolute peak, it was bigger than the entire traditional banking system that we all know and use. It was this invisible giant hiding in plain sight, and it was just about to trip.
So, what do we actually call this giant? Well, economists have a name for it: the shadow banking system. And for the next few minutes, we're going to figure out what that really means, how it all works, and why this $20 trillion shadow matters so much.
You know, to really understand shadow banking, we have to start with a pretty simple question. What makes a regular bank, well, a bank? And more importantly, what's the one crucial thing they have that a shadow bank is missing? And this definition really gets right to the heart of it. See, shadow banks act a lot like the banks we know. They do something called credit and maturity transformation, which is really just a fancy way of saying they take risky long-term stuff like mortgages and turn them into what feel like safer short-term investments. But, and this is the key, they do it all without the two things that make your bank safe: federal deposit insurance and access to emergency cash from a central bank. They're flying without a public safety net. And this chart just lays it all out perfectly. Your bank, it's funded by customer deposits, like your checking account. A shadow bank, it's funded by something called wholesale funding, basically short-term loans from huge investors. Your bank has that public safety net, right? The FDIC, the Fed, stuff that was put in place after the Great Depression to stop bank runs. A shadow bank relies on private guarantees, or sometimes no guarantees at all. This lack of a public safety net, that is the fatal flaw we're going to come back to.
So, if they aren't taking deposits, what on earth are they doing? Well, the best way to think about the shadow banking system is as a giant, incredibly complex factory. A factory that doesn't make cars or widgets, but a factory for creating credit. Let's take a look at the assembly line. The whole goal of this factory was a kind of financial magic trick, a bit of alchemy, really. It was designed to take thousands of really illiquid, risky, long-term things, I'm talking about 30-year subprime mortgages, and transform them, step by step, into investments that looked and felt as safe and easy to trade as cash.
And here's pretty much how that assembly line worked. It was this long daisy chain. So first, you have the loans being created. Then, in step 2, thousands of those loans get bundled together into something called an asset-backed security, or ABS. But it didn't stop there. In step 3, those securities got sliced, diced, and repackaged again into even more complex things like CDOs. At every step, the idea was that the risk was being spread out, diversified away, until finally, this end product was sold to big investors like money market funds, who just needed a super safe place to park their cash overnight.
And if you think that sounds complicated, well, take a look at this. This is the actual map of the system from the Federal Reserve report we're using. The authors themselves joke that you should probably print it out as a giant poster just to wrap your head around it. I mean, it is a beautiful and frankly terrifying work of financial engineering. This whole factory, this entire interconnected web, it was all built on a handful of very important assumptions. But what happens when one of those core assumptions turns out to be catastrophically wrong? What happens when a system built in the shadows is suddenly dragged into the light? Let's just remind ourselves of the scale we're talking about here. At its absolute peak, the shadow system was 1.5 times the size of the traditional banking system. When a system this big starts to crack, the shockwaves are just enormous. And here's exactly why it was so fragile. This whole system was funding long-term, hard-to-sell assets like mortgages with overnight loans. And the private guarantees holding it all together, they were built on the belief that a nationwide housing crash just couldn't happen. They completely underestimated what's called tail risk, the risk of that catastrophic system-wide event that everyone thinks is impossible. And when that impossible tail risk actually happened, those private guarantees became worthless. Confidence didn't just fade, it vanished overnight. This triggered a run, but it wasn't the kind of run you see in old movies with depositors at ATMs. It was a modern silent run. The big investors, the money market funds, they all just refused to roll over their short-term loans. The factory's power was suddenly cut.
That run started quietly in the summer of 2007, and then it just got worse and worse through 2008. The only thing that stopped a complete and total collapse was the US government stepping in and basically providing the public safety net that this shadow system never had. They had to become the lender of last resort for a system that was specifically designed to operate without one. So in the aftermath, the system got smaller, sure, but it didn't disappear. And that left policymakers with a really profound and difficult question about what to do next. Because get this, even after the crisis in 2010, the shadow banking system still accounted for $16 trillion in credit. It was smaller, but it was still a massively important part of the economy. You couldn't just get rid of the whole thing.
This quote from the report just perfectly captures the dilemma. The government's emergency actions, well, they brought the system into the daylight, right? They temporarily gave it the public backstops of a real banking system. But those were all temporary fixes, and once they expired, the system was just pushed right back into the shadows with all its fundamental weaknesses still there.
Which leaves us with this final critical question taken straight from the authors of the report. So what do? Do you bring this system into the light for good, give it that public safety net, but also saddle it with heavy regulation? Or do you try to regulate it out of existence entirely and maybe sacrifice some of its efficiency for the sake of stability? It's a huge debate that is still going on, and there are absolutely no easy answers.